especially for new fund spinouts. No one does math anymore. No liquidity. Godspeed to whoever is out raising
You
right
don't
now.
need to do math. We have AI now.
Oh,
Intelligence
true.
is too cheap to meter.
Yes.
Yeah, that's true. We have to take AI to meetings and let them speak.
Yeah.
And then more funds will get raised, I think.
Yeah, break it down for us. Name names. Who's the
Oh
dumbest
gosh.
venture LP in the Valley? No,
No, I'm kidding.
No, I wasn't even in SF, but I don't want to throw it in
of course,
under a
of course.
bridge.
Yeah.
So I was in a big money hub, if you will, less
Okay.
probably tech companies, but a lot of capital.
Sure.
And I did, so I try to every 6 to 9 months, just to like set the stage here. I try to just go to the LP tour, existing LPs. As you guys probably know, you want to get to know institutional folks years before they invest, or that's the expectation that they know you for a super long time. So I do my, grand old tour across the US, twice a year. And this was one of those. So I took 6 like hour-long meetings in person over the last 2 days with like endowments, pension funds, you name it, all of which are largely pretty active in venture or have become increasingly so. And so, yeah, just setting the stage there, but happy to either you guys, let me know what's most interesting. I can just give you high level.
Yeah, break down the post. There was kind of a lot in there, but the idea that ventures clearly an important asset class, or at least we would always like to believe, even though it's a small percentage of actual dollars allocated. I'm curious. The quote, "No one does math anymore." To me, that stood out as potentially, you have a $200 million seed fund, you start running the math, and you're like, wait, we need to back 6 unicorns at seed to deliver a 2x fund. And then is that what you're kind of getting at there? Was just like,
I don't want to butcher some quotes here from meetings, but I think it was along the lines of fund managers come to raise funds. I think, and what I should caveat is it seemed like a lot of the house cleaning was done on the existing kind of blue chip relationships with a lot of these institutionals, like a couple over the last few years. So I think that the negative sentiment was actually towards maybe newer funds, or like the funds that are on fund 3 and fund 4, but going out and still trying to raise these like aggressively large, like over $300 million funds. It seemed less, I think they did some house cleaning already when they were frustrated with the big funds that they've had in the portfolio for over a decade, and did some house cleaning there. And so I think that feels like it's sort of settled. They've picked the folks they want to concentrate with. But I think the new relationships are getting a little bit blurry. And so from that perspective, it was a lot of, how are we supposed to invest in like the next generation of the blue chip funds and like be in their fund 2 and fund 3, when we have these folks coming to us who don't have a portfolio construction model, trying to raise over $100 million, which may seem small to folks, but it's a lot of money. And then they're saying things like, I forget exactly what the CIO said to me, but something along the lines of like, yeah, so I'm asking like what returns the fund, and like, oh, we expect, of our like 25 to 30 positions that like 5 will be decacorns and like 5 will be unicorns, and that like it's just and then you guys get it from there. And so it's like, wait, I'm sorry, can you please back me into the math? And so they were saying that like, 80% of the meetings they take, and these are folks on fund 2 and fund 3, like clearly have never like opened up a spreadsheet and like walked through portfolio construction. But I think they've been able to get away with that for their past few funds.
Do you think part of it is that math is not commonly used in venture because you're kind of trying to predict outcomes 10 years down the road, but then that CIO is getting pitched by some traditional private equity fund that's basically saying, we are going to invest in 6 companies a fund, and they need to do we're going to exit within 4 years, and all we're really aiming for is to just consistently get sort of an 8% return on.
Well, there's 2 different types of math a VC can do. They can do math about the market size and DCF on the value of the company they're investing in, but then they can also do math on the portfolio construction side. And it feels like vibe investing might be okay. Just find the insane founder, invest in, it's 1 on 10 or it's 2 on 20, whatever. That might not matter. But if you're not thinking about the portfolio construction at all, you might turn away some LPs.
And then simultaneously, the other thing that I think is interesting is venture and private equity were always in the same category, yet they're starting to like overlap more in different ways.
I mean, I felt like one CIO that manages like I think they're around 15 billion was saying to me that like she's like I'd rather just do private equity all day. She's like the IRR is better. She's like I have a window into like liquidity that is not that long, and so they're obviously safer investments. I think where people are, I would say that the net takeaway is that folks are just sitting on their hands, and I think frustrated that they're still sitting on their hands, as in there's no liquidity, so there's no one would say this, but there's not a lot of fun that's going on right now. Like no one's super excited about like these massive exits where they've got to think that the problem that they're thinking about is where do we deploy this cash, right? Mm-hmm. Like most folks go into every year and they have a 5-year plan and they know we're going to deploy $1 billion into venture this year. Mm-hmm. But I think that's just been the other takeaway was from really large folks that are active in venture. I don't know how everyone else is still investing in these funds when no one has any cash. Like they're like, I just don't understand. There's been no liquidity for any of us. We don't have a lot of money to deploy right now. Like, I don't know where this like cash is coming from. And so it just seemed like some of the bigger, I think more legitimate folks that have been around in venture for a long time don't understand maybe the newer entrants.
Hasn't it always been driven just by shifts away from other asset classes? Like, you know, large LPs rotating out of real estate or treasuries or the public markets. Like anytime there's a boom in venture, it's always dwarfed by the other asset classes. So we're just looking at like, if they take, you know, 2% of their equity or their public equity strategy and roll it into venture, that will like double the size of venture, right?
Yes. Yeah. Yeah. No.
And maybe they're tapped out.
Yeah, but it's hard. I mean, right. This is just all cyclical, right? Like we're going to be in a world, I bet in 24 months, I hope that I'm on the show and we're talking about this and everyone's going to be like, wow, we like tripled our exposure in venture and everything's going fantastic, and like poo poo on private equity. And like, you know, so I do foreshadow, like I foresee that happening. I think that just for right now, it's just been like 3+ years of crap. And I think everyone feels like they're taking this beating. So no one's optimistic.
Well, is the 3+ years of crap coinciding with a boom in AI? You know, 58% of venture funding in Q1 went to AI startups. Mm-hmm. Is part of it, do you feel like LPs are like, yeah, well, we had to stretch ourselves a little bit thin effectively so that we could get as much exposure here as we wanted? Or like, yeah, how do you think they're like, yeah, I'm curious, in many ways you would imagine that I think over time it will become clear, like, yeah, deploying into, you know, AI startups from 2022 to 2025 was, you know, yeah, there were some overvalued companies, but like some generational winners, I would hope. Mm-hmm.
Yeah. What does seem to be true is that, especially with AI, and there's so many unknowns, right? Like how much capital these companies actually need. We're seeing record-breaking seed rounds, for example, and insane prices, like Mira's company, 2 on 10 billion, like goodness, you know? So I think a lot of it right now is, it is actually making more sense to me that I think the data last year was that, like, what was it? Like 75% of VC funds, or maybe north of that, went to like 10 funds, or sorry, capital raised for venture funds went to like the biggest ones, the GCs, the Andreessens. I imagine a lot of it is that, one, they're clearly master storytellers. So they're able to say like, here's what we estimate will happen in the market and how much we need to deploy now. And maybe those vintages will be fantastic. I think what is really confusing, and some of the conversations I was having, and I actually got this data. I saw DST did this presentation for some of my portfolio companies a month ago, and they wouldn't give me the slides, but I have it like burned in my brain, which was like, at growth, what's super hard is that for growth funds is that they've traditionally underwritten companies to say, great, if you're a DST, you've got 30 billion plus in AUM, you're typically a growth investor. You're looking at a company and your timer starts for their year-over-year growth once they hit 2 million in ARR. And so like from 2 million in ARR, is that if you grow, and it's kind of nuts, and I might be butchering some of this, but we can like verify it. But it was like, if you're growing only 200% year over year from 2 million in ARR, then it will take you like, I think it was like 29.5 years to be a $10 billion company. They're not going to invest. That's like forever. If you're growing 300% year over year, then I think that number was around like 14.5. And if you're growing 500% year over year from that 2 million, I think it was like 7.5 years.
Sure.
But what happens when that window from like that 2 million, right now companies are going from like 0 to, what was it, like 70 million. I just saw in like a year or like 2 years. So the entire underwriting model of like a great business for growth funds is broken. So everyone now, I'm sure from an LP perspective, is like, are you YOLOing cash? Like, like what is the new model that you guys are underwriting to? Like, what does a great exit look like? And what is the big question you get in venture is like, how do you identify a great business? Like, what are the metrics that make sense for you to deploy 50 million into a business? And like, I shouldn't speak for DST, but they were like, they talked to all the other growth funds and all the guys that run them, and they're all sitting around a dinner table wondering like, well, how do we underwrite these businesses? So I imagine as an LP, you're thinking, shoot, I'm going to trust the guys that have made us a bunch of money over the years versus these net new, let's say AI funds where no one knows, right? And they haven't proven that they've done anything in the past.
On the AI stuff, maybe on the venture side, do you think the Windsurf rumored acquisition by OpenAI changed the conversation? There was a big meme: don't build a ChatGPT wrapper. GPT-5 is going to steamroll you. Well, it looks like Sam might be opening up the piggy bank and shelling out for some companies that could be described as somewhat as wrappers. And if that trend continues and all the foundation model companies are buying a ton of consumer products that are built on top of them, well, those could be some really great exits. What is your take?
One thing is we don't
the conversation.
We don't necessarily know. We don't have details on that acquisition. It might not be a liquidity event, right? It might just be like, our Windsurf investors getting rolled in. I'm sure there's
they're getting votes in the nonprofit.
yeah, nonprofit.
Yeah,
I
have too many questions there that I have answers, right? Like I actually don't even know who most of Windsurf's investors are and how much.
It's a Green Oaks deal, actually. Green Oaks did the seed and the Series A.
Of course.
Neil Meta.
Monster amazing. No, that's amazing. Look, I hope that people make it. Look, we are all incentivized to see some cash, right? Like to see some liquidity. I think I would summarize all of the sentiment to being just like, obviously, as you guys know, lack of liquidity. And so people are looking for new reasons to get angry. Like I was hearing even things like, I hate the 2 and 20 model. It's such BS. And then big funds ask for more than like 20, if they hit like over a 3x net, then it becomes 30. And like, I feel like a few CIOs were like, F this market, but that sentiment's going to change as soon as they see liquidity. And then it's going to be like, oh my God, it's amazing. Our exposure's like tripled. I just can't wait for that to happen. I just think people are grouchy.
Grouchy.
Are you telling an AI story to LPs that mirrors cloud or mobile or fire or electricity around AI? You kind of pick your metaphor, and depending on how bullish you are, you pick a more extreme metaphor.
Look, I think me co-founding a business to build next-gen AI data centers shows where my head's at. It's in the infrastructure, like the physical infrastructure and the power. And so and that's obviously non-Wischoff Ventures related, though I've told you guys, like I gifted my shares into the funds. But I think that that's like a non kind of LP pitch from that perspective. I think from a Wischoff Ventures perspective, I am very bullish on the vertical AI applications. I think I don't know who can, I can't really predict where everything goes at all on the AI front, whether it's horizontal, it's foundational. Like I don't know. What I will say is the more specialized you are in your vertical and the more you can enable a home services business, for example, to, hire less people and bring in more business. I think the more insulated you are, it's harder to rip you out. And so I'm really, really all in on like these vertical applications where folks are specialized and they can kind of walk their users to this type of automation. I think people really, really don't think deeply about how hard it is to get people to adopt this. I know the idea is to decrease headcount, but no one understands this stuff. No one knows how to implement. No one knows how to think about it. And so I just think it's down to the folks that know how to tangibly articulate the value of an offering. And being an SF, and it's kind of why I'm grateful not to live there, though I love it, not knocking it, but you just kind of get sucked into this, oh my God, of course, it's so obvious. Everyone's going to adopt and pay $1 million for this, and enterprise value is going to balloon. And we're forgetting that there's a whole world out there that's never even heard of GPT. And so, maybe
are you staying away from consumer AI? I talked to a founder yesterday that pitched me what was a great idea and application of the tech, but I just immediately, he was tell me why I shouldn't do this. And I was I believe that this is not something that OpenAI has explicitly said is on their roadmap, but is an obvious thing that agentic, an agentic assistant would just do automatically. And so how are you thinking? Are you feeling a lot more confident in these sort of B2B verticalized applications versus a lot of consumer right now, if it's not network driven?
Anime filter was not on the OpenAI roadmap, but they crushed it just
Yeah.
by working on images long enough, right?
It's like NFTs. They come in and they're so cool for like 5 minutes, and then it's like, wow, we spent a lot of money there. I mean, that's probably not fair. And if watch NFTs come back in like 12 months, but like I think that the honestly, I don't know. I mean, I toy around with a lot of this stuff. Like the great thing about consumers is that I can just mess with it and like try and figure it all out. I don't know that I found anything even personally sticky enough that I'm like every day, like, like messing around with it. And well, I guess it's not fair. Like obviously like OpenAI, like Claude and Perplexity. But I think like on the everyday, I haven't really, I always have an open mind. Some of the YC companies I've seen have been super interesting, but I haven't really found longevity for myself using them as like personally. But maybe my mind's not open enough. I just try to think, I realize this is a pretty irrational business than some, like I try to take more of a rational lens around like, could this make it 10 plus years as a durable business?
You're hiring in San Francisco, looking for 2 to 3 folks that are operators. Why did you settle on that language, operators? We've talked to VCs who have been top of their class at Goldman, come in and just work the spreadsheets for a decade and put up historical runs.
Look,
also founders, but operators specifically. Why do you think that's the key to success in venture?
Look, I think for my style of what we do and like where we try to like add value to companies is absolutely saying like, oh, been there, seen that, like, here's what worked for us, here's what didn't. And like just being fast to that response because things have to get done. I have hired, so I have Neil on my team as a senior associate, and he comes from venture, doesn't have operating experience. And so this July, when it's quiet in DC, and Neil is full-time at one of my portfolio companies in LA as on the biz ops team operating. Like that's important to me. Like I'll cultivate it. Like that's the thing I want in our DNA. If you don't have the operating experience, I don't want to lose you to it, but you're going to go get it. And so I want to keep that DNA. I think it matters. In SF, we need exposure there. Over half the deals done last year, were in California. We do a ton of deals in SF. We see a lot, but I want folks that are boots on the ground. It's sort of kind of like to start, I want to hire someone there full time, but for now, sort of like scouting people that are excited about venture, but still really like operating, that are writing small checks, but I want to pull them in. So unlike scouting now, where you just source and then ideally get some carry, I want them to see a whole deal through. They source a deal that we do it. They're joining every call. They'll learn how we underwrite the deals, how we do the work. And then eventually they can put that on their resume if they want to, but we'll see. And ideally I can hire one that's fantastic. But just an approach I want to take. I don't know how these venture firms do their thing and do their scouting stuff. I don't care. But it's something that I just want to test out and see how it works.
Very cool. Jordy?
No, this was great.
This
I wanted to just get a gut check for, I mean, we have a lot of managers that listen to the show that maybe aren't fundraising right now. Hopefully they're having, doing little mini checkups.
Doing some math.
Doing some math.
2 plus 2.
Open up that calculator app.
To answer the question, how do you return 50 million, whatever your fund size is? Like literally, and then walk through tangible examples. And apparently no one does that or can do that on the fly.
You just need $1 trillion company in the portfolio.
Exactly.
Just get out the unicorn, decacorn thing. Just buy 10% of the next Facebook.
Seriously.
For $100K.
Yeah.
It's easy.
No, and the other thing that was interesting is I didn't mention this, but I was asking about spin outs. There's a lot of great people, I think great, spinning out of notable funds and raising funds. And I think what's confusing for them is they were like, look, a lot of these guys took the strategy, even the blue chips do this, and this is why they're so active in seed. And this is coming from the LPs. They're so active in seed because the individual investors are like, well, hey, if we take 30 million and divide that out by a ton of $2-3 million checks, if we lose a few, it's not such a blow to the reputation of that partner at the firm versus taking a $30 million check and putting it into one company and saying like, hey, like I'm a pretty good picker if that works out. And so I think it's made it really, really hard to underwrite these guys because they've just done whatever they wanted and candidly haven't taken a lot of risk or maybe been able to. So it's going to be interesting to see specifically. I think right now we're seeing the most probably good quality spin outs. It sounds like over the last 6 months raising funds. But I think it's also, I thought that like, shit, it's just hard for me because I've never been in venture before and I'm trying to like do something substantial. But it turns out that like even the folks that spin out are still getting kicked in the teeth. So I think what you're saying, go meet LPs really early and be able to answer these like tangible financial questions. I mean, it seems obvious it's not, but like it really, that matters.
Yeah, it's funny to look at if you just ignore like, looking at a spreadsheet of portfolio construction and you just look at somebody and you look and you say, if this person has $100 million to deploy in the next 3 years, do I think they're going to be able to give back hundreds of millions of dollars? And when you really just like look
Ask
at
that
somebody
question.
and just like ask yourself that question, sometimes I look at a manager, I'm an LP in a fund here in LA, run
And you
by
didn't do any math. It sounds like that was a Vibe LP investment.
It was a Vibe LP investment, but I look at, I'm talking about a buddy of mine, Jack Dreyfus, and like he's got a $30 million fund. I look at him and I'm like, yes, I believe he's going to give back around $100 million to his LPs. And like, it's not like it's purely vibes based, but the guy knows how to, knows how to do deals. And
well, the other, and I'll leave you guys this. I know we're over. Is like, so I was talking to like a managing director at a pension fund that's got like over 55 billion, and they're super active in venture. And he was actually saying, he's like, go after the pensions, because he's like, endowments will actually leave you, like they will churn, but he's like, pensions don't. So if you get in, it's like pretty sticky, but they do have a high bar for like emerging folks. But he was like, he's like, I could make a killing if I left here and just advised managers that are trying to basically institutionalize, because he was like, the hard stuff are things like when to exit. He's like, you could have great access. You could actually pick the right deals, and you could just never exit at the right time. And he's like, that is just like a lot of what we see. So there's just an art to how do you institutionalize your firm that he's like, a lot of folks miss. So if emerging managers are listening, that's like the big chasm that is really hard to cross. Like, have you hired appropriately? Even if you're a solo GP, like, do you
Wait, but when you talk about when to exit, are you talking about, let's say, a breakout company in the portfolio is raising around at $5 billion and there's enough demand for the round, and you're saying like when to exit those positions, or what did you mean by that?
I would say that largely most folks, especially emerging managers, at least as far as I know, are tell LPs, and this is what I do as well. I'm not a public markets investor. When my companies go public, as soon as we're out of lockup, like that's ideally around the time that we sell. And then it's your responsibility to do what you want to do with the shares. So I think a lot of it is on the way there, especially, I mean, and this is probably a lot of what we're seeing because of 2021. A lot of folks should have probably sold secondary on the way up because people got priced at like sky high valuations, and there was secondary happening all over the place at an insane premium. And I think they're referring to VCs never selling secondary. And then those rounds go from being a $5 billion Series D where they could have sold secondary in 21 to like $1 billion company right now. And they're sitting on these, and it's like just still on the books. And so I think it's a lot more of that never happened, but that's hard.
Well, that's another reason to keep your fund small, because if you have a $50 million fund and you get an opportunity to sell a secondary, like that could return the fund potentially. But if you're a $500 million fund, it's hard to ever figure out an opportunity to sell secondary that's going to like meaningfully return the fund or anything along those lines.
And that stuff can haunt you too, because I'll hear stories of people selling Facebook when it was like, $20. I think I heard the craziest story from Tiger once, which like, I don't actually, never mind. Never mind. I was like, I don't even know if that's on the record. But yeah.
They love doing PR. Actually, Tiger loves just like they're an open book.
I was like, that
guys.
is not my story to tell.
There's definitely like not a book about them where all the names are changed, floating around.
Actually, no, it's got to be public knowledge. Oh my God, they sold so early at Facebook. That's all I'll say. It hurts because they
plenty
didn't
of people sold. I mean, Sequoia sold Google, and we've talked about this. Like they IPO, and then they just distribute, and it's like, oh, like they sold Google at like 50 million or 100 million or 500 million, like way too early.
By the way, I have no idea if that. Look, I just think it's the angle, the approach you want to take. If they want to take that capital and the returns they made and dump it right back in, then they should do that. But
yeah,
awesome guys.
Anyway, this is great. We'll talk to you soon.
Thanks for squeezing this in, and have a great weekend.
Y'all too.
See you soon.
All right, thank you.
Talk to you soon. Bye.